Hello and welcome to another episode of Malone Bailey's official podcast, Everybody Counts. Thanks for tuning in. I'm Carolina from the recruiting department at Malone Bailey. Hopefully this isn't your first time tuning in, but if it is, welcome. Our podcast, Everybody Counts, features various perspectives on a variety of topics, from the latest SEC and FASB updates to discussions on recruiting, retention, and more. Everybody Counts explores trends and hot topics that affect us and those in our business. Tune in to hear from partners and staff alike. The conversation is versatile and everybody's input counts. I'm your host, and today we're diving into an important topic, FASB's Accounting Standard Update 2023-09, Income Taxes, Topic 740, Improvements to Income Tax Disclosures. Joining me today is Nicole Zhao, tax partner at Malone Bailey, who's here to help us unpack what this means for public accounting. Welcome, Nicole.
Thank you for having me. Excited to be here.
Excited to have you. So let's start with the why. Why or what made FASB say, okay, it's time to change how we disclose income taxes?
Great questions. Investors have been asking for more transparencies. They want to understand how companies' tax strategies and global operation affect their tax rates and future cash flows. The previous disclosure requirements were helpful. However, they didn't go deep enough. So FASB issued this to improve two key areas: rate reconciliation and income tax paid disclosures.
Okay, so it's really about transparency, giving the full picture, not just the headline numbers.
Exactly. It's about helping financial statement users make better decisions.
Okay, and you mentioned rate reconciliation as one of the key areas affected by this update. Can you shed some light on what changed regarding rate reconciliation?
Public business entities or PBEs must disclose a quantitative reconciliation of the statutory tax rate to effective tax rate in standardized categories using both percentages and dollar amounts. Also, for items that are greater than or equal to 5% of the statutory tax amount, they must be separately disclosed.
Okay, so that's definitely a lot more detailed than I had previously read.
It is, and if any item is greater than or equal to 5% of the statutory tax amount, it must be broken down further by nature and sometimes by jurisdictions.
Oh, wow. And then the second key area of improvement mentioned was income taxes paid. What's changed there?
All entities must disclose income taxes paid, disaggregated by federal, state, and foreign, as well as individual jurisdictions where tax paid are greater than or equal to 5% of the total taxes paid.
And so all entities, really?
Yeah, public and private entities must disclose income tax paid by jurisdiction. It's also important to know that pre-tax income as well as income tax expense or benefit need to be disaggregated by federal, state, and foreign.
Okay, so let's say, for example, we're here in Texas and paid a lot of taxes in Ireland or California. Would that need to be called out?
Yes, it helps users see where the cash is really going, not just where it's booked.
So is it true that private entities usually get a bit of a break here?
Somewhat, they don't have to do the full tabular rate reconciliation. Instead, they will provide qualitative disclosures. Basically, a narrative explaining the big differences between their statutory tax rate and the effective tax rate would be good enough. But when it comes to the income taxes paid, they follow the same rules as those public entities.
Okay, so they still have to break down where the cash went.
Exactly. That one applies to everyone.
Oh, good to know. And then very important, can you remind us, everyone listening, when this goes into effect?
For public companies, this rule applies to annual period beginning after December 15, 2024. That's actually what we are working on right now. And for other entities, this rule applies to annual period beginning after December 15, 2025. Remember, early adoption is always allowed.
Okay, so to summarize for our listeners, why do these changes matter?
It's all about making tax disclosures more useful. Investors get better data to make their decision, and public companies get a chance to show how they manage tax risks. And overall, it brings more consistency and transparency to financial reporting.
So more clarity and less guesswork.
Yes.
Thank you so much for joining us today. This was super helpful. I'm very appreciative of the time you took out of your busy schedule to chat with me about this topic today.
Thank you for having me, Carolina.
Now, before we head out, we're going to switch gears and play a little game we like to play on the podcast called This or That.
Mm-hmm.
I'm going to ask you a question and you'll choose which you prefer. Ready?
Sure.
Okay, coffee or tea?
Coffee.
Sweet or salty?
Sweet.
Vacation or staycation?
Of course, vacation.
Yes, I think I'm going to have to agree with you on the vacation there. It's been lots of fun chatting with you about this topic today, Nicole. Thanks again. And to everyone listening, we appreciate you listening in and invite you to check out our website, www.malonebailey.com, for more information about public company audit services, as well as tax and consulting services, and some other useful resources. Thanks again for listening.